I have the chance of having 4 VCs here to talk about their perspective on InsureTech and their investment thesis. My name is Yann Ranchere. I'm a partner at Anthemis. We're doing fintech startups investments. And I would just ask the panelists to give a 2-3 sentence intro on each of them, and then we can jump in right in the topic.
Sure. Matt Streisfeld. I'm a vice president at Oak HCFT Partners, which is a multi-stage growth equity fund focusing on the healthcare and fintech verticals. We've raised a $500 million fund about 2 years ago, made 2 investments so far in the insurance space, and just continues to be active in fintech.
Andy Lerner from IA Capital. IA stands for Inter-Atlantic. We've been around for 20 years focusing on fintech, insurance tech investments. We're a little different than other VCs, and we get our capital from the insurance industry with a mandate from our investors to make strategic investments. So Prudential, we've been making strategic investments for Prudential for 16 years in the space, and we're invested in agencies, carriers, lead gen, claims processing, a variety of investments in insurance tech.
Rick Zullo, I'm a vice president over at Lightbank. We're an early stage venture fund and development company. We've invested or incubated or developed about 100 companies since 2011. We have 3 plays that we're pretty excited about in the insurance space: Snapsheet, Risk Match that we just announced, and a healthcare company that we incubated with Glenn Tolman called Zest Health.
Good morning, Jan Hammer, partner at Index Ventures. We're a San Francisco and London-based venture and growth fund. Earlier this year, we announced approximately $1.25 billion of fresh capital, of which a large portion will go to the broader financial services and insurance space. We've been investing in, fintech and insuretech before these kind of buzzwords were even invented. First investment in what was then Weatherbill, or later Climate Corporation in 2006, exactly 10 years ago. So we're looking for more investments in this space.
Okay, so we have, interestingly, and I think after Matt's presentation, we have 4 VCs here who look at both fintech and insuretech. And if we look at this conference, and that the fact that we have so many people in so early in the cycle, it seems to me like insuretech is like growing even faster than fintech was at the time. And why do you think it's so? And just a bit of expansion on the opportunity space and the speed of how fast is the opportunity space growing, Matt?
I mean, I think with regards to insurance in particular, it's one of those areas that, around the industry, everyone knows that there's some pain that lies with regards to the carriers. There's opportunities that need to be in terms of, innovative with technology. A lot of the carriers, when you think about the big incumbents, that they're still on green screens, COBOL, right? It's sort of still legacy technology infrastructure that's been built. And it's worked, right? It's the underwriter that is focusing on experience rate underwriter doesn't need data because it's all based on their history. But you've got $200 billion of overcapital from a capacity standpoint. You've got a tremendous amount of OpEx and acquisition spend that's being provided. It's being spent every year in the insurance space, and so it's very much ripe for the opportunity to bring new ideas, bring innovation, bring data to sort of the 21st century for insurance carriers. And you're starting to see the interest, and you're starting to see these innovation groups by the carriers that they want to do this. And where they may have lagged, where the banks and the lenders were 5 years ago, you're actually now starting to see this need and interest in actual investment by these carriers. And I think that's what's really driving a lot of that investment.
And Andrew, you've been, very long in the space, and so do you think it's different? Like, do you see that the continuation of what you've seen, or do you think there is a really different wave starting now?
It's a new wave. Just like Matt said, the carriers are underinvested compared to the banks, so they're trying to play catch up. And I think that what's different now is the talent. We're seeing better startups than we ever saw before. The most talented young people are going into insurance tech and fintech generally. So I think the quality of the startups and the technology and the innovation is something that we've never seen before. Whether it can be sustained for several years is another question, but definitely it's been a sea change in the last 12 months.
Okay. And if we look at that insuretech space, it's very, very broad. And so what are you guys looking at? Broad insurance is such a wide sector. There is various opportunity space there. What are you looking at? Rick, you've made 4 investments, and there seems to be quite a broad perspective there. So,
Yeah, so I think Matt hit the nail on the head that there's a lot of structural inefficiencies in the insurance market that, there may be a little bit more fat there than was in other aspects of financial services to cut away. So, for me, I focus exclusively on enterprise. So, we love working with companies like Snapsheet that has been able to really drive efficiencies, and they're in the auto insurance industry for claims processing. A company like RiskMatch that has been fairly disruptive from a customer acquisition and connectivity and reducing some of the opaqueness in price discovery for commercial P&C. So, we think that there's a lot of room to run in the commercial landscape. A lot of really interesting things happening there. And then obviously we're spending a lot of time looking at marketing and customer acquisition plays as well as cyber. So, it's no secret that cyber is going to be a huge opportunity. There's a lot that needs to be proven out with the actuarial models, but given the stage that we invest, it's an area that we're spending a lot of time looking at. So.
And Yann, you've done Weatherbill, which was climate insurance, but I'm sure you've been looking at a very much broader scope. So, what's your take on?
Yeah, we have. By category, I guess we've continued with the founder of climate, and we're investors in Metromile today. So actually, I sort of agree here with the panel. Auto is a big category, but we're looking across the categories. I would argue it's more interesting to look at which slice of the stack is interesting and sort of go more by slices of the stack, and probably spending most time on the sort of the decision and the information aspect. I guess more than ever before, there's data that you can collect about the underlying risk of whatever you're insuring from new sources, and sort of providing leading indicators to ultimately risk you're insuring, which you couldn't do before. And then you can run a lot of data science and machine learning on top of that. So we're looking primarily at information-rich companies and information-rich opportunities. And
geography-wise, you have a fund that goes from London to San Francisco, and insurance is a very diverse business in terms of geography, right? You have countries like Australia as a 99% direct insurance market model, and you have Germany is like the opposite side, and everything is intermediated by brokers. How do you see that opportunity space from a geography perspective? Do you see differences, and how do you tackle that part?
Yeah. I guess at Index we believe that entrepreneurs can be born anywhere, and have invested in both Europe as well as US, probably about half-half. Certainly in the UK, we see a lot of activity in the space because of the sort of proactive approach by the regulator. But we've also invested in Australia and further sort of more remote places. And I guess today you can be anywhere as long as you, obviously cloud and mobile distribution allows you to reach consumers and end users no matter where they are and no matter where you originate from. So our investments, I think the number is something like 25 countries that we've made investments in. Not all necessarily fintech or sort of broader financial investments, but sort of the general footprint is pretty diverse.
Well, I was just going to say, I think the UK and Europe at large was kind of an early leader in this space. InsureTech probably popped up a little bit earlier there than it did in the US. And, one of the interesting things as you look at the difference between insurance and other financial services verticals is, you look at some of the areas that investors popped up in fintech in London and New York City was where the predominance of activity. Insurance carriers are everywhere. So insurance brokers are everywhere. So much of kind of the value in the industry is created in markets that a lot of Silicon Valley entrepreneurs, aren't there. So we're seeing very different entrepreneurs that are coming around, and being successful that don't kind of look and feel like a 23-year-old wearing a hoodie, hacking away at a computer, which is, caused people to kind of rethink the way that there's going to be innovation in the sector, and I think that's a good thing.
And it's an interesting point, Rick, because I agree. I think you're seeing in London and Europe in particular, you're seeing a lot of innovation. I think regulatory environment has enabled them to do that. But then you go to like London, you go to Lloyd's. I used to have a Lloyd's syndicate, and business is still done with broker slips, and they line up around sort of the various boxes. And the aviation group and the marine group are still doing it by relationships and paper. And so you think about Lloyd as sort of the largest insurance exchange in the world, and they're still 100% paper based, right? It's completely antiquated. but nearly the majority of the large property, casualty, and some of the indemnity risks that are written in this world are written from that that 10 Lime Street or from 1 Lime Street. So there's a huge opportunity, even just slowly but surely, to working with those carriers to help them just automate, be innovative, thoughtful about sort of efficiencies. And that's where a lot of I think the opportunities are lying. And I think the startups are seeing that, and that's why we have so many different variants of companies here at this type of conference.
And just, we're going to discuss a bit the carriers and the relationship just a bit later, but just to tackle on the idea that we have a different type of entrepreneurs and they might not be the same as the typical. So, you were saying you see a new crop of high quality entrepreneurs, but is there like a typical InsureTech entrepreneurs, or what type of founders you're looking for? What type of, what do you want to see in an insurance startups founder? Yeah, well, we see a variety, and we focus on North America, but we invest in agencies like Bolt Solutions is the largest digital agency. We invest in carriers like Hamilton Insurance, which Brian Dubrow is going to speak tomorrow. Specialty life insurer called Crown Global we're invested in. Homeowners America, homeowners insurance we built from scratch. And then, but I think the biggest area is distribution and lead gen. In the last year, we led rounds in smart asset and credit testing. We're seeing a lot of disruption, a lot out of Silicon Valley, in acquiring customers in new methods, and I think that a lot of the young entrepreneurs want to tackle distribution, B2C, which is also the most heavily regulated, perhaps if you're a carrier. But I think that it's more industry people that get into the weeds and have SaaS or SaaS type solutions. But I think that a lot of people go in and say they don't understand the regulatory nuances of insurance, and that's good and bad. You want a fresh thinking to tackle the problem, but a lot of people get caught up in the insurance. So we like entrepreneurs that want to come in, tackle fresh problems, but also we want some insurance industry expertise on the management team as well. Yann, would you say that's describe what you're looking for?
Yeah, it's broadly true. I would just sort of push even further, and I would say that the industry is complex, and maybe that's one of the reasons. Your very first question, sort of, why is it happening now? Why is there so much interest in InsureTech right now? I guess you could say capital-intensive industry. You can really lose your T-shirt if you get it wrong. So it's complex, and therefore disruption comes later. But I would then say it's not different from other industries. We are at Index, we're looking for founders who are missionary, very sort of mission, thesis driven, come up with a disruptive, different point of view, go and build a better product, fundamentally something just order of magnitude better. And sort of the good news will sort of flow out of that. If you build a better product, customers will come to you. And that point about the entrepreneur, the founder in a T-shirt, Silicon Valley stereotype, it can be a good thing, because if you're the underdog and sort of in the spirit of art of war, if you go unnoticed, I think you have a greater chance of sort of building something under the radar, and suddenly incumbents could sort of be surprised what's being created. And we've seen that in many industries, many a time over, where the existing industry incumbents sort of underestimate the disruptor, just because the disruptor comes sort of as a cool new app in it, with a founder in a T-shirt. So we'd encourage all those ambitious entrepreneurs to have a stab at the problem.
But to be fair, the incumbents have done a tremendous job, I think, in partnering and being friendly to these new solutions, recognizing that a lot of their own core competency isn't doing what the 23-year-olds wearing T-shirts is. So, I think that's a great thing that, we see a lot of carriers and folks in the industry that are partnering in innovation groups and venture funds. And, we've been very, very happy to work with them. And I don't think we saw that as much in traditional fintech. And, I think it hurt a lot of those institutions. So, we'll see whether we've hit peak insurance with 1,500 folks in the conference. But, I think, it creates a lot of opportunity when these carriers can work with entrepreneurs and kind of help them figure out the complexities of insurance regulations and so forth. So.
Yeah. Actually, a good point, I think, wanted to lead to talking a bit about regulation. So we're going to have a 5-minute regulation talk. She's going to make it more serious right now. Do we have regulators in the room, or just to see what we can say and not say? Joking. So I mean, we were involved early on with the founders of Simple. I knew them in New York, and I remember vividly one of them saying, the difference with me and a traditional Valley entrepreneur is if I make a mistake, I can go to jail, which I think is a right statement of what's happening, and that is unique to InsureTech and FinTech is the regulation aspect is critical, and the consequences of not doing the right thing can be critical for the entrepreneurs. How do you see that play in terms of, do you see possibility to push the boundaries of regulation, or do you want entrepreneurs that try to do that? Do you want entrepreneurs that are very concerned by regulation and just want to follow the guidelines? I mean, how do you tackle the tension between regulation and innovation, if there is one, if you think there is one?
It's a great question, because you don't want a startup to be sort of, inundated with regulatory thoughts, right? You want them to be innovative. You want them to think about how they can make adjustments. But if you're, which is why it's sort of distribution is really tough. If you're in any type of holding the pen type of capability, you're binding it, you're sort of you need to be a registered broker, you need surplus lines. I mean, you have to understand the nature of the regulatory environment. And what I think is tough, in particular with the U.S., is that all 50 states are really, even though to agree, you'd say that New York and California sort of lead the way. All 50 states with the insurance commissioners all sort of look at the world very differently. And they're all very, very important at each sort of, in each state. And so you have to have some mentality and some thought process about how we're going to either work with the regulators or provide our technology platform in a way that we're not a regulated entity, but you need to have the concept of how regulation comes into their product. Otherwise, you're going to get killed, because it's such an intrinsic part of the insurance process, like if we like it or not, but I don't think it's going to change anytime soon. And with Dodd-Frank, they never changed sort of the national insurance charter, so I think this is going to be for a little bit.
Yeah. Well, we don't want our companies to push the limits on regulation, because our capital comes from insurance companies that are by nature conservative, and we don't want to get them in any trouble. But what we're seeing is a divide between B2C and B2B in FinTech and in insurance tech. In FinTech, you have the CFPB, which regulates the B2C companies, and you have much less regulation on the B2B. On insurance, there's something somewhat analogous. Any product that's issued to consumers has to be fully licensed, but if you have a B2B insurance product, maybe you can have excess surplus lines and you can avoid some regulation. So there is a corollary. We're seeing more regulation in FinTech now than we are in, you would think you'd deal with one regulator in Washington is easier than 50 state regulators. Not really true.
Yeah.
We're seeing more regulation in FinTech than insurance tech, but somebody that's a tech generalist that comes in and sees insurance says, "Whoa, this is so regulated." But from our standpoint, from working with FinTech for the last 20 years, it's really not as bad. But mark my words, the next few years there's going to be maybe more innovation in B2B, because the entrepreneurs are freer to do more things than B2C.
Yeah, not much to add to what we said. Our companies, we definitely guide our companies to work with the regulator. And I think there's an opportunity to always influence, but definitely not, sort of cross the line. I think it's good to realize that actually being compliant with something that's complicated is in itself a barrier to entry. If you get it right and it's hard, then that puts a sort of a certain moat between your business and those who don't know how to do it.
And maybe so the regulators in the room can now raise their hands. Just because we saw, at least in Europe and at least the UK was the example of that, is that if you have the right regulatory framework, or you have a regulator that is open to innovation and is creating sandboxes and those kind of concepts, it led to more innovation. Any recommendation for regulators? I mean, what would I was kind of surprised by your point around having someone in Washington is not necessarily a good thing in terms of having the ability to push the boundaries, and it's maybe easier to have 50 regulators in some aspects. Can you expand a bit on that, because it seems counterintuitive?
Yeah, I think that I see one entrepreneur after another that says, we're not worried about regulation because our product is better than what's out there. But I think that's a little naive. I think that you still have to follow all the rules to the letter of the law, whether your product overall is good for consumers or not. And I feel like a lot of well-meaning entrepreneurs get caught up and frustrated in regulation. So I think Washington cares about the letter of the law, and they'll stop a company to do one thing, even if 90% of what they do is great for consumers. I think that the state regulators will sit down and work with an insurance company a little bit more and give their blessing. And then once you're domiciled, your home state signs off, it's a lot easier to get approval in the other states. So it's just from our experience, there's maybe more of a willing to work with a company as a whole on the state level than federal level.
The one thing carriers, one of the many things that carriers do really well is that they've got regulatory capital and they know the forms, filings, and sort of licensing process, in all the various states. So, to Andy's point, a lot of this innovation that we're seeing in B2B and being able to partner with the carriers and utilizing their regulatory capital, both from actual tangible and intangible, is going to be, I think, a tremendous opportunity to enhance the rate of innovation, because I think you'll have the regulators sitting on one side saying, all right, we know someone that they know what they're doing, they've been doing this for 40 plus years, and they've got skin in the game. And the other side of it, all right, we've got technology that's helping better enable the customer experience, either via B2B or B2B2C or B2C, whatever it may be, and help actually improve sort of the way that the inherent insurance company is operating. I think that's where we're going to see a lot of those opportunities. I think that's where the regulators are seeing it already and are willing to work with these startups.
And to lead on that, do you see a path for, regulation is also one of the big protection for existing players because it's so hard to get to their stage. Do you see a path for full stack insurance startups? To like carriers, alternative carriers? Oscar, obviously the one that is in everyone's mind, and in the banking sectors, we've seen a couple of new licenses in the UK. Do you see a path for companies to become carrier or to become highly regulated entities? And also from a capital perspective as VC, how do you envision that?
Yeah. I certainly think that it will inhale capital, though. So I think it's not going to be cheap, and for us that's not the model. We get involved in companies pre-product, as early as possible. So I do think that there will be folks that attempt that, and we'll see how the market plays out. Obviously, IA has had some success in doing that in the past, but it certainly takes a lot of capital to do that. Where it's a competitive marketplace right now. So I think a lot of people are thinking about speed and taking different slices of the tech stack and trying to find ways to differentiate. Where when you look at some of the core benefits of being a carrier, that's balance sheet strength. It's going through the having the regulatory capital, tangible and intangible, as Matt said. So those aren't exactly core competencies of a traditional startup. So if you're going to do it, it's probably going to have a different feel and not come out of a small early stage venture firm like us, but probably more so out of institutional players who want to take a big swing and be comfortable putting up $50, $100 million. So. Yeah.
Andrew?
Yeah, I agree. I agree. It's going to take time. I think you can see full stack in one product line, right? So you could have full stack in auto insurance, but you're not going to have a startup compete with State Farm across all their business lines. That's just not going to happen in any meaningful, reasonable amount of time. But it does take time to build these carriers, and you need the capital, as Rick said. But sure, I think there's room for a few of these to be successful.
And one other thing to point is, the capital itself is very expensive, but also just acquiring the customer is very expensive, right? You've got Geico and Esurance, they spend over $1 billion a year just trying to acquire a customer. I think the industry on its whole, the P&C in the U.S. industry spends, I think, like $70 billion a year just in acquisition costs. And so, to really, I think so. Yes, I think actually creating a full stack insurance company is going to be very feasible. It just takes time, and it's expensive, and you just got to make sure you have the right infrastructure and the right partners behind you.
Part of the interesting way to do it is through kind of similar to the way that you mentioned with Metro Mile. You find something that's a core differentiating technology asset, and then as the company has de-risked and kind of matured and demonstrated that the technology is extremely meaningful, at that point there's a play that be made with a carrier.
Yeah.
So,
It may be over time. I mean, we've seen examples of this trend in our portfolio, whether that's companies like Robinhood in brokerage or Adyen in payments. And again, say in payments, you can start with sort of gateway, accepting credit cards, then you add processing, then you add acquiring, and suddenly you're a full-fledged, full-stack payments company. It takes time, it takes capital, and I guess self-awareness that you need to sort of nail all the competencies that come across that vertical spectrum. But I would say as an investor, if you get to that point, that's the really valuable thing. So it's a goal worth aspiring to.
And just for to transition to the next panel, we were discussing early on the relationship between carriers and startup and having that, both symbiotic but also competitive relationship. How do you see that play out? And especially, I think the main difference here is that the carriers have been so active in investing so early on in the cycle. And I think Matt was saying that they're the most active at seed stage, which is surprising for corporate VCs. How do you see the relationship? Trove, you're an investor in Trove. There's a lot of relationship with various type of players in the industry. How do you see that play out?
I think it will continue. I think someone like Trove, who's partnered with 2 different carriers, or actually 3 different carriers, particularly when you think about the geographic mix. And I think you're seeing it's almost twofold. On one end, you've got carrier partners that say, look, we want new access to customers, we want new access to information and offer new products, and they want to provide enough capital support to help that startup and get off the ground. And then you have someone like Munich Re, who's saying, look, we want to be the distributor of all your products, we want to be the underwriter of all your products, but we want you to sort of go run with it. What I think, taking all that step back, I think what you're really seeing is, the innovation groups at these various insurance companies have great ideas of how technology can work with them, and love over time to actually see some of these innovation groups actually have P&L responsibility. And see them having a $200 million book of business that they're responsible for, and growing that sort of new product and a new distribution channel. Because I think that's where you're really going to start seeing a lot of these changes at the insurance carriers, because I think they want to do a lot of good, and it's just there's a little bit of friction internally that they always come up with. So having that P&L responsibility is going to be, I think, a great way for the startups and the carriers to really sort of work, and I think that will take it to the next level.
Yeah, we co-invest with a lot of the big carriers, and some of them have very excellent VC arms, and you'll see that on the next panel. But we're really talking about the top 25 insurers in that. What about the other 1,000 insurers that are smaller? They're kind of getting left out of innovation. They don't have the resources to have full-time innovation or VC teams. So it's one reason that we're out there trying to make strategic investments for insurance companies, so they can leverage us instead of building their own in-house VC teams. But I think it's a dichotomy, right? The top 25 are making all these interesting investments, just like the 4 of us, and then the rest of the insurance industry is getting left out from innovation.
And just to conclude, as we're running at the end of the panel, from each of you, what are you looking at right now? And what topics, what are the things that excites you? What type of entrepreneurs you would like to see come after this and talk to you afterward and to pitch their startups? What is interesting, Yann?
So we are currently in the process of completing an investment in sort of company liability insurance and sort of company risk. It's an investment we haven't announced yet, but what's really interesting about the company is that they sit at the source of sort of the lead indicator data through their sort of app distributed through an app store, sort of self-reported data by the enterprises that are customers and sort of subscribe to the SaaS product, and the data is sort of the input for pricing insurance risk for those corporates. I guess so. The general point is what we look for is something differentiated. We're sort of not looking for the fifth copy of sort of the one and the same model. God forbid it's just going and taking investors' money and spending it on kind of Google keywords. I guess those days might be over because arbitrage sort of takes away your advantage. So we're looking for something new and different, and sort of most likely it's going to be around the use of data. Rick?
Yeah, and keywords aren't exactly cheap in the insurance sector either. So, on that, I think, we see $70 billion of customer acquisition spend, and we look at insurance being a pretty large percentage of Google AdWords, and we think that there's probably an opportunity for some marketing automation, vertical CRM plays in the industry. We think that that's kind of exciting. We, as I already mentioned, cyber is an area that we're spending a lot of time. That market's going to go from 3 to, depending who you talk to, somewhere between 10 and 20 in the next couple of years. A lot of greenfield opportunity there. As we look at a lot of the incumbent software solutions, the Vertafores, the Applied, the Guidewires, there's a lot to be said for being able to service those 1,000 insurance carriers that need a solution that's cloud-based or a little bit more nimble. And probably the fourth area, and this is IoT, is an area that we play a lot in as fun, that we'll probably see a lot of innovation happen in underwriting, risk management, claims management, kind of the full life cycle of insurance in the commercial segment that's related to IoT. And we've looked at a few interesting opportunities that we've gotten pretty close, but nothing there yet. So.
All right. And just very briefly,
we'll look at everything, but I think the distribution lead gen's a little crowded, so we're leaning a little bit towards what Rick looks at in terms of BPO or SaaS solutions like Snapsheet. Rick found before us, but that's a good model for what we look at.
Yeah, we actually love the claim space. When you think about the pain for the carriers on losses and LAE, it's a multiple about 2x, 3x of what we're spending, what they're spending on acquisition. And there's two lines of businesses that we think, which have blown up insurance carriers over time, which is workers' comp and commercial auto. And when you look at sort of the last 10 years of bankruptcies and inherent sort of runoffs of these carriers, those are two lines of business that have created a lot of pain. So looking at ways to be more innovative in the workers' comp and the commercial auto space, which are massive lines of businesses that will continuously need to be written, but are ripe for new information, new data of those strategies.
All right, thanks everyone. We're running out. We're just going to leave the stage to the people who give so much money to Google. Apparently that was the statement here. And thanks everyone for the time. Thank you.